fourth day of 2016. You know, as a trader in the markets, especially as an active one looking for cash flow and alpha, you know, you have to have a strict set of rules, and you also have to have parameters you look at on whether the market's acting healthy or whether the market is acting sick, or if the market is just a little nuts and it's a crazy avoid. Now, entering this year for the first time in a while, most sectors were all below the 8-day, the 21-day, the 50-day, and some even below the 200-day. And I tell everyone about the rules on what type of stance to take trading-wise. You know, when the markets or sectors above the 8 and 21-day, most people are in a portfolio approach because you're trending higher, stocks feel good, things are breaking out. When they're in below the 8 and 21-day, you're more tactical. And when it's below the 50, 100, or 200, it's very sickly, and you have to be very careful, risk off, and that's when you get in defensive mode where you have less size overnight. You know, you test lower levels with the plan, and also look for a lot of shorts. I know guys on the VTF, a lot of you have been making some good money short this week. If that's you, congratulations. If you've had risk down trying to trade levels, maybe you've been making some money as well. You know, or even if you had a little longs, it's been hard. But you know, here we are, day 4 into the new year, and futures are down like 40. Okay, the headlines you're going to see all day, actually we were down 50 for a little bit, is, you know, China got halted again, down 7.2% I think on the Shanghai, which now makes it down almost 13% for the week. You know, they devalued their yen again, and I think they said they wouldn't do that, but I guess, you know, how do you take what they say at face value? So that's what's providing a lot of the headline volatility. You know, Europe, the DAX is down another 3.2%, almost down 7-8% to start, and you know, our markets were down almost 3%, you know, before today, now almost 5%. So the question is, you know, are we oversold enough for a bounce? You know, we shall see, right? So what you have to do is write down these levels to think about where we might bounce from, okay? Or if things get extreme, where we might bounce from. Because at this point, you know, oscillators went out minus 40, and now they're probably going to open up minus 70-ish or more, and I haven't seen that in a while. So although, you know, we will be drastically oversold, you know, you still have to be careful, you know, trying to buy in the hole, especially if things get a little crazy and extreme. So if you go to the chart of the SPX, you'll see that, you know, the chart here shows lots of things we just mentioned, which I'll go over real quick. First of all, you know, here was your descending channel that was in place, you know, for, I guess, the last quarter of 2015. And this is where the market closed. You know, this was the last trading day of 2015, closing below all the moving averages, giving you really no reason, you know, to be excessively long. If you were short and you were predicting, you know, a rough start, congratulations. Not the easiest thing to do. And here was your 3-day down move. Okay, this is Monday through Wednesday. And although it looks or has felt horrendous, we really are only, you know, halfway through the range or so from, you know, last year's double bottom lows. So the question is, you know, if this is just a normal type of correction, you know, which it could be, you know, we're already down to this level, which is kind of what I was hoping to see for a tradable bounce. So the question is, now that we're here, does it happen? This level here is 1951 to 1953. Okay, just to show you real quickly, last year, you know, in August, when we were below all the moving averages and things were very constricted, okay, we went down for 2 days, had a big day. This got most people out. You know, some people short. A lot of people made money this day. And then you had that flash crash move, and then you had a decent bounce back before you went back into this, you know, fact-finding basing mode to see whether or not, you know, you would have broken this low and went lower or bounced off it, which created the double bottom. So anyway, for now, as crazy as things feel and as, you know, the 2008 comparisons come roaming around, at this point, you know, off the historic highs, we're less than 10% off historic highs, I think 6 or 7, and only down 3% for the year. So with that being said, you know, you want to potentially try this spot, but you know, if you start the cost average game, it could really hurt you, because again, we're just, you know, from here below the moving averages. Look how far and extended we went here before bouncing. So with that being said, it's also a Thursday. Usually bottoms happen on a Monday or Tuesday, but we shall see. Doesn't mean you can't get a trade today. So that's where we are basically right around this morning. So, you know, maybe try a 5, 15, 30-minute, you know, low to trade the spider's verse. This is a very compelling spot. If we were to open here and push down a little bit further, closer to 1925, this would be a spot where, this is actually where I think, if we get, we definitely hold today. This is, around where we might, if things don't get crazy, this is a spot that I would think would hold. And in my swing account today, when I get back to my seat, because I have 2 accounts, I'll probably be putting orders in from this spot down to this spot if we happen to get, the craziness that we saw, in August, which I don't know, but you can't expect. So in my normal account, I'll look to trade a tradable bounce around here, and then the swing account, into this spot if we see it, today. And as far as, that's that. So you go to the spiders, if you want to correlate, I've been showing this chart pretty much every day, thinking that we get at least a move to this, which is where we are now, and we basically filled the gap already, overnight, and it's trading, I think, right now where it's at 7:50 in the morning. It's about, we're probably a little bit below this 195. So, it feels oversold, but we're really not that stretched. This was stretched. This happened in 5 sessions, and boom. Here, we haven't even really felt the fear. So that's why I'm trying not to, I don't want to start too early, in case some fear really gets. And we actually had these little choppy bounces at the end of the day that kind of prolonged the inevitable. But all in all, we talked about how this hole in the spiders, below all the moving averages is very bearish. So hopefully you're not coming in with too much stuff. Below that spot, you have this, okay, which is 192.50, which would probably be a spot in the spiders that I cost average down from if in the first 30 minutes, they trigger all the stops, etc. And then here's another point of reference, and then here. And I listed them in my Redler All Access note if you look at that. So this is what is this spot? So this high here is 191.82 coming across. Here is the gap fill, and right now we're a little bit in this zone. I think the morning low was 193.75, so this would be your morning low right around here. So maybe they try and get back to there in the first little bit, or at least test that, and then that would be your point of reference. We always have to look for clues on what could rally first, what could help lead us off the lows in a sea of red. Yesterday, some high beta tech names that have already lost momentum went green first. Maybe they try and do it again. So before I get to that, I just want to show you oil, which was the culprit, which has been the culprit for the year. I talk about every time oil makes new threshold lows, the market doesn't like it and volatility spikes. Well, the USO yesterday, made a new, another new threshold low right below here. Okay, so that's what also causes major volatility, because then you never know where it's going to go. Because again, there's nothing below here. You've had this, oversold bounces many times starting last year. This is when it bounced off the lows, got tight, resolved lower, bounced off the lows, got tight again, resolved lower. So if you've been trying to play any of these bounces, there's always been spots to get out of the way. And if you are a guy like me who looks at moving averages, and says, okay, it's an avoid unless it's above the 8 and 21 days of swing, and if it's below the 200-day for a series of time, it's in a bear market downtrend, don't touch for more than a day. Well, just so you know, the USO broke the 200-day at 37. So even if you waited to here, to 32.50, there was no reason for you to suck wind and go underwater as an investor in oil down to here, below the 200-day moving average. Same thing goes for the XLE. XLE broke its 200-day, which means no more institutional support, closer to 82. And it's been below it ever since. So use these rules. This is when momentum left with the head and shoulders top. This is when it broke the 200-day and stayed below, not just a quick fake out. And now look. And again, markets notice when new thresholds lows get broken, and the XLE did it again. I actually came in a little long the XLE yesterday, thinking that it diverged from oil, and I got out pretty quickly because it didn't. It was like a false sense of security right in there. So anyway, here is your new pivot. Okay, so yesterday's low is 57.71, below. It's already below the 2015 low, so leading us lower. And so maybe there's a stretch back to the test of this. It's hard to short this now, considering look how far stretched it is from all the moving averages, but it doesn't mean you could blindly buy it either. The IWM, just to go over before, high beta, very, very weak. You look at this overall pattern here, and on a macro sense, it's not looking good whatsoever. You go across like this, and you could easily see, you answer the question before I say it, macro head and shoulders top pattern. Here's your left shoulder, here's your head, here's your right shoulder, below all the moving averages, first sector to be back, towards the 2015 lows. So this is, you might get some kind of oversold move today, but this is not a spot where you want to start allocating money now. Because if this happens to trigger and get below this and it's real, 130 to 103, you're talking a move 30 points lower, and wow, it's a long way down. That'll take you probably back to, this area, which, oops, sorry, hold on, which is ways away. So lots of bearish things, kind of setting up here. So with that being said, that's not a good that's not a good sign for growth out there, which is a problem, and which is what a lot of people are saying we lack of. And you take more of a short-term look here. This is your 2015 low, so right down 106.99. See if it could hold it today and get back above it for a trade. If not, there's trouble. And look at the size of this breakaway gap to the downside. And look when this lost to 200 days. So if you were to use my 200-day rule, you were, out of dodge around 117 or at least 116, not holding your nose down here at 108. So again, you gotta freaking follow your rules and know what technicals mean. And I don't care if people say moving average don't mean anything. They mean a lot. They show you, the trends, and they show you what small players, momentum players, and big institutions are doing without you having to look at their books. You can just look at the moving averages there. So today, the question is, how do we make money, if we bounce? And let's look at some of the, the high beta tech names. Google, made a move off the lows yesterday. It's down again today. Maybe you find another move like that. Right now, it still hasn't, it's not really oversold. It's just starting to lose some momentum, so you want to be a bit careful. This is when you had the breakout failure, and then I drew this line yesterday, and it held. So right now, I would write down for Google 748. Okay, if it stays above it, it's still showing crazy relative strength. If it were to stay below this, and your next spot is 736, and then I think if things get kind of crazy, this would be a compelling spot to kind of buy, which is the gap from here. So for me, I'm probably not going to be buying Google on the open, but if things get a little nutty, into this spot here, which is 720 to 712, maybe it's today, maybe it's next week, I'm not exactly sure, this would be, a very good spot to, to try and grab. If things stay kind of normal today, and like the last few days, and not just, have a trend crazy down day, this spot probably holds. Same thing for Amazon. Amazon was the first to go green yesterday. It lost momentum, but it's not by any means fully broken. Here's when it had a breakout failure, okay, and then lost a 50-day. Then yesterday, it went green. So the question is, does it hold above yesterday's lows while the market indices are well below it? And that low to write down is right here. So I think it's a little bit below it now, 620. And then, again, just like Google, the compelling spot here, if things start to just cascade and get hit with fear, would be this 593 to 600. That would be a spot that I think, if you do a little cost averaging game, that would be a good one versus level. And if you, come across it like this, that's right there, into this area, and it's not too far away. Again, remember that these things have had enormous moves for multiple years, so you don't want to start too early. But overall, like this macro trend in Amazon is still there, and it doesn't come, oh wow, look at that, right here. This would be unbelievable if you could see it quickly. We all like things quickly. Anyway, Facebook also went green yesterday. Played around. There was a trade there. Now the question is, can it do it again? The good reception for Oculus. The spot right here is around 99.75. It's still in this channel, but it's vulnerable. If it breaks and closes below this, things get crazy. Here's your moving averages and whatnot below it. Okay, it's still very strong, but lost momentum into the end of the year, and now it's become a little bit tactical, trying to hold on. If it doesn't hold this, your next spot is like 98.80. Kind of right by this old high into this moving average. So that would be a decent spot, I think, if things get hit hard off the open. First things first is 99.75, and then things get crazy, that's, you're coming all the way down to here. And we've seen things get crazy before. You can't rule that out. That's why you got to know your risk and your tolerance. Netflix was by far a standout yesterday. So, good book says if something closed strong on volume, it's down probably $2-3 today. That should go green first. So I'm sure every day trader around is going to look at that to go green. So we'll see if it's a trap or not. You can't play it like it's a trap. But, there's also probably some people caught overnight thinking that we had a little follow through tomorrow. So there might be some selling pressure. But, this was a big wide range bar. It's come a long way. It was up a lot. So if you start early, you might get in trouble if it doesn't go green right away. So You look at your 5-minute here on Netflix, and you'll see that there's some support right in here. So I'd say if Netflix is any good today, it would hold somewhere between this 113 and 115, and if it's extra strong, this is big time support. This support right here is 1522, and then here's the zone that if we got to see any kind of commitment to yesterday's move, this is what it holds. So I would take a look at that. Apple's been weaker. We talked about how it's been broken. Yesterday a lot of us are trying to short it at 100. Some held it overnight, some didn't. Now it's below it. You go back to your daily chart of Apple, and it's been very technically broken. You take the name out of the chart, and you never want to be long this thing since breaking, except for a second, breaking this spot here around 115, and now it's continuing lower. The flash crash lows here are close to 92. I think it's trading somewhere around 97. I would say if things get nutty also here, I would be a buyer from 94 down as a cost average, but I don't know if things will get nutty. And then also, seems like a lot of these big gap down days, some flight to quality happens where it seems like their buyback program, kicks in, or some mutual funds, etc. So you do get some kind of move off lows, but you can't buy after that. Typically Apple seems to likes to go down first on up days, and on crazy down days, it sometimes gets some flows. So we'll see if that's the case today. So keep your eyes on Apple. And if you're expecting some kind of rally with any kind of substantiability today, you're going to have to see Apple go green. Even if it's just go green, you're going to have to see oil, kind of go green. You're going to have to see some strength in a little bit in the banks. The banks have been really weak. Goldman Sachs has been bleeding lower every day. Look at this stock too. This stock has been below the 200-day and below this ascending channel ever since breaking right here. So it's been a basic weak avoid, but you are coming down already to the 2015 lows, which is showing you, this has been very weak. You have this also pretty bearish overall pattern. A lot of bearish overall patterns here. If you want to call this a head and shoulders top pattern, we're getting really close to the neckline. So maybe there's a quick bounce here because it's really oversold, but granted, it's been below the 200-day for quite some time, and since last April, it's basically been trading above it besides this little fake out here. So that's an unhealthy sign for Goldman Sachs, who's supposed to be the best out there. Let's see what JP Morgan's doing real quick. JP Morgan, just below the 200-day now. Okay, so I'd be a bit careful there too. This is best in breed, commercial bank, besides investment bank. It did try and rally yesterday. It's been acting stronger. It's not even near the lows the way Goldman is. So, I would look maybe to see if any banks can go green today. It would be JP Morgan. And JP Morgan has some support, I guess, a little closer to 61-ish, or right around here. It's been battered and bruised and broken. Look at the size of that. Resistance there. Big hole to start the year. A lot of ugly technicals. We can't control the market. We can only control our keyboard. And try not to be in the frame of mind of missing out. For me, I feel like I've been a little like, oh, I don't want to miss if we get that big bounce back, and it hasn't happened, and it might not happen. Yesterday I was really hyper focused on Twitter and here to say, listen, the rule book that we had from 2009 till half into last year, I feel like it's changed. What does it mean it's changed? It means that this could be a down year. Fed Fisher basically came out and said, they made the market run excessively to create a wealth effect. They have no bullets left, so you have no more pace of purchase there. You have China growth slowing. You have our numbers aren't great. You have Europe still in there's stuff going on, and the market's had a major move, and we're still only 6-7% off the highs. So you got to be very nimble, and you have to be nimble and quick. What was that nursery rhyme? Jack be nimble. Anyway, so with that being said, if you're getting caught in stuff, be flat overnight. Don't worry if you miss out on some kind of big move. If you've been in pain, the market doesn't know where you started your pain. I know some guys were long from the start of or the end of 2015 and stayed in it because they felt like they had a sunk cost in it or were committed to it, and then that just turns into a bigger loss and a bigger loss because the market has no idea when you were in it, and it doesn't matter where you're in it for where it's going to bounce from. So you can always clear the sheets, clear your head, and then start getting some green days together, and then you'll get some more confidence, and then perhaps the days will get bigger. And at this point, I'll say it's going to be very oversold. We went over a lot of levels in the spiders and the SPX. Lots of poor technicals out there, but I have a feeling today's going to be a tough day to be short. The last 3 days have been tough. If you didn't come in short, it was hard to make money short also because of those cute little rallies at the end of the day. So, either which way, they're not giving away money. So don't think that people are just killing it. And if they are, they have a thesis. And if you don't have a thesis, then you have to trade it back and forth. My thesis was this year, risk well outweigh the potential for upside. And you take that for what it's worth and keep, as an alpha trader, limited positions, be tactical, look for the red dog reversals, look for the H cell setups, and we'll do that until something changes. There'll be some good pockets of trading them short of the long side, but I have a feeling the majority of the action could be to the downside. So, don't let that be a surprise. Have a great day trading. I'll see you to recap, and just trade and live within your means, and everything else usually works out.